Good morning, everyone. I delayed the start just a moment this morning because some people are telling me again that there is a bit of a delay and you're not hearing my intro. So I hope you're hearing me now. I hope you all had a great July 4th and you had maybe some time off. And I know a lot of people took some time off, went away, went to the shore, whatever they were doing. So I think it's the not having the webinars after the holiday Monday is working well for me. I hope it's not a problem for you. You should start seeing these webinar recordings, not only on our website, but sent out via email very soon. We've been really good about getting them up on the website in a short period of time. What I want to start doing is delivering them to your email box as well, so that you have them for easy access. But it's an evolution, just like everything else. We've been thankfully very busy in our practice. We've had more growth in the last 6 months than we've experienced in some years. So we appreciate that from everybody. We do try to tamp that down where we have pretty significant waiting lists of at least a month and a half at this point. But I want to thank you all for that. And there's always a lot of work to do for our existing people as well. So, we want to manage that. So let's get into it here. What we're going to talk about today is, of course, we're going to do our slot updates. I do want to remind everyone that you are muted. You're being recorded, of course. And I just want to check in. Just raise your hand for me. Hit the raise hand button if you can see me and hear me. Okay. Wonderful. Thank you, everybody. So we finished up the last series of our classes. I'm going to try something new with the advanced class. And as always, I'm open to suggestions there. But with the upcoming advanced class, they're going to be on-demand webinars. And the reason we're doing that is, it's some scheduling is challenging, especially in the summertime. And I like to have these special webinars in the advanced class on Wednesday night. We do have one coming up discussing long-term care. I can't pull my calendar up without being too distracted, so I'll share that with you via email and during our next webinar. But that's not coming up until the end of August. But I'd like to squeeze in the advanced classes between really now and the end of August, but I want to make it a little easier for you. So what I'm working on is an on-demand webinar series. So you can really start it at any time, whichever works for you. Start it and even stop it, come back to it. We're going to try that for this run of the advanced class series. And then you, of course, can give me your feedback on that. Okay, so let's start with our slot updates. Excuse me 1 second. Of course, we're waiting for CPI updates. I'm looking at headlines. We're looking at CPI updates coming tomorrow. That should drive some of what we've been seeing in the markets. I don't expect any. We'll just see what happens. So today or this week in the slot updates, we're gonna this just came out, I guess, last week. The topic is, should I accept a lump sum buyout offer? So I'll share my screen so you can read along. Okay, so you should be able to see my screen now. Just raise your hand for me. Click your raise hand button if you can see my screen. Thank you. So this addresses, should I accept a lump sum buyout offer? So they're specifically talking here about pensions, and we deal with this a lot. We have a lot of folks who come to us and they're not yet collecting their pensions. And the question is, should I take this buyout, lump sum payout? Or should I just continue with the pension? And there's usually a lot of options for distributions of your pensions. And this also talks about a buyout. So this happened, sometimes it actually happens while people are receiving their pensions, right? Because a pension is a big obligation for a company. These are usually company pensions, not government pensions, where you have these lump sum or buyouts. You sometimes with a government pension, you have a partial lump sum, but it's all obviously depending on the plan. So, the big one recently was a few years ago. Bristol Myers had offered, had actually sold their pension to an annuity company, Athene. And during that time, when they were preparing for that, all the employees had an opportunity to roll their pension into into an IRA for them. So that's a big consideration to make. So Ian Berger explores that. So let's go through this together, and I'll try not to read it word for word, but I probably will. So should I accept a lump sum buyout offer? And that could either be, you're offered a buyout from your pension plan, or when it's time to make a decision about your pension, you have an option for a lump sum distribution. So before I start, the reasons you may want to consider a lump sum distribution are, you have more control over that money. Once you start your pension distributions, you usually can't change them. So that can lead to a tremendous amount of tax rate risks in your plan. Not only that, you'll increasingly pay more tax on those pension payments, because we all know that we believe that taxes have to increase significantly over the next 8 to 10 years. But it could affect your taxation of your Social Security and many other things, tax credits. So if you have the ability and flexibility to roll that into an IRA, that is a tax-free event, you don't pay tax if it's properly done when you roll your pension lump sum payment to an IRA. And then perhaps you can have a schedule to convert that if it makes sense to you, to a Roth IRA. And then once you convert that money, you never pay tax on that again. So any distributions coming out of there would be tax-free out of the Roth, as long as you meet the 5-year rules. Of course, you pay tax on the conversion amount, but that's the math equation you have to do to see what makes sense. So that's one reason why a pension lump sum may make sense, is tax efficiency, some more flexibility in your own investments, but there are reasons why it may make sense to keep it in the plan as well. So let's explore some of the pros and cons. So with economic uncertainty, Ian writes, more companies with defined benefit pension plans will likely attempt to improve their bottom line while offering lump sum buyouts. A lump sum buyout is a limited opportunity for pension plan participants to elect a one-time cash payment in exchange for giving up future periodic payments. Some buyouts are offered to participants who are near retirement age, while others target those already receiving benefits. So it does happen from time to time where people already receiving those benefits are offered these buyouts. Deciding whether to accept the lump sum buyout is an important choice that you shouldn't make without consulting a knowledgeable financial advisor. Now you're seeing all my notes. I'll let you catch up, because I know the screen lags sometimes. Here are several factors you and your advisor should be looking at. What is the effect of interest rates? So this is something we've been seeing quite a bit lately. As interest rates rise, these buyout offers tend to drop. Really, they're calculating it on how much money you're going to need to generate the monthly amount for the pension. So as interest rates rise, that amount needed gets smaller. It's been very beneficial for pension lump sum distributions in previous years. Of course, while interest rates were very low, these buyout offers kept increasing and increasing. Now we're seeing it go the other way. So the lump sum amount is calculated by taking into account several factors, including an assumption about interest rates. The lower the interest rate assumption, the higher the lump sum. With interest rates rising fast, this may be a good time to seriously consider locking in a lump sum instead of waiting for later buyout window to open when interest rates may be higher. And interest rates are one of the key concerns we have about the markets right now, are just rising interest rates and rising inflation. And it's questionable if the Fed can keep a damper on these. So this is certainly something to consider. How financially secure is the company? That's something you have to look at. Pensions are sent to this Pension Benefit Guaranty Corporation, or the PBGC. If the every company pays into these, just like banks pay into the FDIC, and the benefits can sometimes be 25 cents on the dollar. So the PBGC does insure pensions. I'm down here. Pension benefits up to a certain amount, but even though the PBGC financial picture has improved somewhat, it might be risky to count on that lifeline. So that is not a government agency. It's not backed by the federal government. So that's something to consider as well. Will your spouse agree? If you're married, your spouse must consent before you receive a lump sum. So you've got to make sure your spouse is on board. This usually isn't an issue for our clients, but how tempting will a lump sum be? So some people will take a distribution from a lump sum. They'll get, sometimes millions of dollars, sometimes hundreds of thousands of dollars, and they'll want to make a big purchase with it instead of putting it into their financial plan. So I've never had to counsel anyone away from that, but that's something to consider. And then know the tax rules, of course. Defined benefit monthly payments are typically fully taxable in the year received. You can't roll them over. So you can roll over the full lump sum distribution, but if you start receiving, say, $4,000 a month, well, you can't roll that over. You're going to take that as distribution, and it's going to be fully taxable. New Jersey, if you're a New Jersey listener, we have different rules for how state taxes applied in New Jersey, and you've got some exclusions, and then once you're over the exclusion, you pay tax on distributions for pensions and IRAs. In Pennsylvania, we still enjoy tax-free, state tax-free IRA distributions and pension payments. That is likely to change in the next decade. From everything I hear coming out of Harrisburg, it's just really unaffordable for Harrisburg to continue doing that. But lump sum payment is eligible for a rollover to an IRA. Of course, as I said, that is just like your 401k rollover. There's no tax held or paid during that process as long as it's done correctly. You roll that money directly to an IRA, and then you decide how to distribute those funds. Now, of course, once you put it into an IRA, you're subject to the age 72 currently RMD rules, but hopefully you have a plan before that to manage those. So once you roll your funds over, your funds may become subject to the requirement and distribution rules. But aside from that, you have lots of flexibility with IRA withdrawals, iron rights. These are some important issues that should be part of any consideration about accepting a lump sum buyout offer. Remember, don't make this crucial decision without getting help from an expert. Yeah, there's many smart people out there that have pieces of information, and it doesn't serve them well. So it's good to have somebody who can kind of just pull it all together and give you some objective advice. IRA basis and Roth conversion and RMD. So this is a good one. So these are the mailbags. So it starts with this question about basis in an IRA. So what does that mean? That's different than your basis in a taxable account where, you can either have a capital loss or a capital gain. You can't do that in an IRA, but where you do have your basis is if you have after-tax money that's contributed to an IRA or a retirement plan. So people can certainly do that. They can make with an IRA, you can make a non-deductible IRA contribution if you'd like. And often in retirement plans, you can do after-tax contributions. And then the problem with that sometimes is that it's difficult to keep the records. And most people don't. Many people don't. And this is an example. So Mary writes in, I'm 66 and would like to convert one of my IRAs to a Roth IRA. But I'm not sure if any of my old IRA accounts have any after-tax contributions. I have no records, so I assume they are all pre-tax, but I'm not sure. If I convert and pay taxes, does the IRS contact me regarding after-tax contributions if I ever made them? So what do you think? Is the IRS going to contact her and say, hey, we found that you're going to, some of the money you converted shouldn't be taxable? I've never heard of that, and I wouldn't expect that. So the answer here, and I'm not sure this is again, Ian. The answer is, unfortunately, IRS will not tell you whether you have any basis on account of managing after-tax contributions. Instead, it's solely up to you to establish that. You indicate that you have no records, but we suggest double checking to see if you have copies of Form 8606 that you may have filed with the IRS to claim basis. So that's the form that you use for after-tax contributions. Also, you may be able to track down the 5498 that's issued by the custodian. So the 8606 and often is offset by the 5498. They connect just like a 1099 is offset by a 5498. And then match up prior tax returns to see if you took a deduction for your IRA contribution reported on the form. If you can't prove you have basis, you have to treat all of your IRAs as pre-tax. So this is another reason why I believe a good CPA has to be part of your team, because a good CPA is going to help you keep track of these things. And while you may pay a few $100s a year, sometimes more, to have this work done, it can save you a tremendous amount of time, frustration, and money in the future. So very, very important to keep those records. Many people do. We had a client who had a question about Roth contributions, and And he was able to go back decades with his records. Very impressive, but that is few and far between. Most people say 86 what and 54 what? Never heard of those. The last is from a financial advisor who I'm going to just save my comments about this, but from often we have questions that come into the Slott group from financial advisors and CPAs and even attorneys who don't know, they're working within the realm of Roth conversions, and they've heard about these things, Roth conversions, and think they might be a good idea, but they're not experts in the area, and they ask pretty basic questions. So here's one you probably know the answer to, but hello, we have a client with an RMD of $100,000. We also believe they should do a Roth conversion of $200,000. This is becoming very popular with the markets down. If they are looking to execute their Roth conversion now while the portfolio is down, can they execute the $200,000 Roth conversion today and then wait to take their RMD of $100,000 in December of this year? So I'm thinking you're probably saying, no, you can't do that. You know the rules that RMDs have to be taken out first, but Josh doesn't know that, but he does now, because he was told, sorry, that won't work. When an RMD is due in a particular year, the first dollars distributed from an IRA in that year are treated as RMDs. So if they tried to do the conversion first, they would have to come back and really take that money out and it would still fully be taxable as the RMD, but they wouldn't be able to get that $200,000 that they wanted to over to the Roth conversion if they don't figure it out by the end of the year. When a person does a conversion, it's considered both a distribution and a rollover, so the RMD must be satisfied first. After that, any amount over and above the RMD can be converted. So I hope that makes sense. You got to satisfy that RMD first, and then you can convert as much as you like, whatever makes sense for you. All right, I think that's the end of our Slott discussion today. I'm gonna stop sharing. All righty, go back to my notes. All right, let's talk about the market. So, oh yeah, I put this up front. This was something that came out of a different area than I usually go to, but it's from this fellow, Leon Cooperman. Sometimes I see some of his reactions to his comments come through our analyst reports. So Leon runs he's a chief executive officer of Omega Family Office, a large investment, family office, small. They handle ultra wealthy family. Usually often one family, but he's a well-respected investor. So he's had an interview with Bloomberg Television Radio in response to the concerns about inflation, looming recession. So this person favors stocks, and actually the analyst reports today are going to be very, very conflicted. So you're going to hear some people say should be investing in stocks, some people say you should be investing in bonds, and I want to share that with you because even the best and the brightest out there are very conflicted about what to do going forward. But there's an answer for that, of course. So Leon writes, for most of my career, there was a real return associated with buying a bond, he said. Now with inflation at 8.6%, but the 10-year treasury yield only around 3%, it makes no sense. And that makes everything in the stock market look attractive. It'll be difficult for inflation to cool down, given the tight labor market, according to Cooperman. We're in an environment where there's much more demand for labor than there is supply. That's not an environment where prices go down. So he's seeing inflation continue to rise. He goes on to talk about the Fed having a difficult time keeping inflation down, keeping interest rates out in control. So he thinks with those things combined that it's better to buy stock. It's an interesting perspective. And I'll come back to the markets and just keep going about the analyst report since I shared that. And let me find a conflicting one to offset that, because the Wall Street Journal article was positive as well. BlackRock came down with a report downgrading stocks, updating credit as bond. We see a new era of volatility, inflation, and growth sweeping aside the period of moderation, they say. We downgrade stocks, they use the word equities, and upgrade credit bonds in this new regime. U.S. jobs data last Friday reinforced the supply shock causing persistent inflation. Yields resumed their rise as markets priced higher odds of rate hikes. They said U.S. inflation is in laser focus this week. Persistently higher monthly inflation rates could cement the case for a 75 basis point, 0.75% Fed rate hike later this month. So we've got one analyst or investor saying, I'm going to overweight. I'm going to just buy stocks. I'm going to stay away from bonds. And then BlackRock, the largest manager in the world, is saying, we're downgrading stocks. We're going to focus on bonds. Robert D. Lucia from Prudential / Empower, he says there's a high likelihood of a recession within the next several years, but probably is much lower during the next 18 months. The classic preconditions for recessions are not yet in place. Financial conditions remain favorable. The labor market is robust. Real interest rates are deep. In deep negative territory, and the physical imbalances that normally cause recessions are not evident. The squeeze on household incomes caused by the rise in food and energy costs will clearly have an adverse effect on consumer spending. However, there are other offsetting positive factors that should support consumer spending over the next year. He talks about the inflation adjusted borrowing costs are low. That's interesting. That's an interesting point given inflation so high. There remains more than $2 trillion in excess savings on household balance sheets. The current level of excess savings is the equivalent of 13% of personal consumption's expenditures. And he goes on and on and on with several bullet points about why he believes that we're not yet in a recession, nor will we see one for a couple of years. There are many economists who say we're in a recession now. And I believe that people, even with cash reserves, are certainly beginning to tighten. There are people that are still going to continue to spend, but most people, the sense I'm getting from what I'm reading and individuals I'm talking to, there's a lot of concern out there about the future, and people tend to hold on to their cash when that happens. From the Wall Street Journal article, The Intelligent Investor, I forget this fellow's name now off the top of my head. He said, wow, what a first half that was in the markets. And sure it is. You've heard how bad it was, but has anyone suggested you try thinking about it this way? So he lays things out in a positive way. Bonds became 10% cheaper in the past 6 months. Emerging market stocks got 18% cheaper. International stocks got 19% cheaper. Large US stocks became 20% cheaper. So did publicly traded real estate. The Russell 2000 index of smaller stocks got 23% cheaper, and big growth stocks got 28% cheaper. So that's an interesting way of looking at it. We've heard about that before. He goes on to talk about we should replace CNBC and MSNBC with the Benjamin Graham Financial Network, and he talks about how it should be reflecting the sale price of things right now. And I think that's a great positive way to look at it. The question is, if you're at a 25% discount in what you're buying, if you're buying stocks, or a 10% discount if you're buying bonds, the question is, where is that going to be? Are they going to be higher or lower 6 months, a year or so from now? So I hope you're seeing that that these analysts are all over the place. We have a lot of differing opinions. Of course, the answer, folks, is asset allocation, true asset allocation, monitored well, principal protection, and account segmentation. So there are the three things. You want to build that foundation. Now, at times like this, we have to look outside the box. We're implementing some, I don't want to say unusual, but strategies I haven't used since 2008, 2009. You've heard me talk about buffered notes, barrier notes. These are things out there that offer us some protection on the downside and some growth on the upside, and they're issued by banks, and I'm looking at purchasing these for clients in the 1.5 year, 2 year period. It just depends. I'm looking for some stabilization before we start implementing on both interest rate side and market side. So right now we're still holding a lot of cash, and I'm really fine with that. But we don't want to do it forever. It's been a few months now, and I think that's reasonable. It's been a blessing. The other thing is we haven't had a single client that I can think of that's had to sell out of any position for a loss to fund their needs. And you want to make sure that's where account segmentation comes in. You want to make sure that you've got that cash on hand to cover periods of times like this. So it's really important to have the different, you want to call them buckets, different levers to pull to fund the things in your life, because you don't want a situation where you enter retirement and then suddenly can't pull money out of your investments because they're down and you're worried they're going to go down later. So I appreciate the positive sentiments. I also appreciate the more cautious or negative sentiments, because it tells us really what we should be looking out for, and also tells us that nobody's got the magic bullet here, and you have to be cautious but optimistic at the same time. But you've got to have a plan, and we're going to talk today in our financial planning topics series section about the financial planning process. So I think it's good from time to time to go back to that and see what we should be doing, and hopefully you are doing. So I'm going to share this chart that I get every week from Invesco with you, so you can kind of look at the numbers with me. And I'm starting up here on the left-hand side, and you'll see this is the week ended July 8th, 2022. So that was last Friday. So equities or stocks. So you see the Dow Jones Industrial Average that was up for the week. Actually, all the major indices here were up last week. The NASDAQ being the highest, it was up nearly 4.5%, a little over 4.5%. So it was a positive week last week. The Dow Jones Industrial Average is still down almost 13% for the year. And you'll see the S&P 500 is down 17.5. The NASDAQ is down 25%. The MSCI World, not including the US, so the rest of the world, basically, 18.2. These are emerging markets, 17.4, and you can see continue down there. And as I've said before, this is what is surprising most people. You'll see that these bond indices are also down. They were down last week, many of them. But year to date, negative 10%, 10.5% for the most, probably the largest area of investment for typical investors is that aggregate bond index, what that index tracks, and that's down nearly 11%, low over 10.5%. High yield index is down 12.8%. Even these short-term bonds are down 3.2%. So that's really what's shocking investors, because they're seeing these losses on both sides of the portfolio. And you'll see here that the US Treasury, I'm over here in the middle now, if you can see my cursor, the 10-year Treasury closed the week last week at 3.08%. The 2-year Treasury is almost the same. So why would you invest your money over 10 years if you can get the same return for just a 2-year note, right? That's with the concern with a flattening, or what they call inverted yield curve. We talked about that many weeks ago. The prior week was 2.88%, so increase from the prior week. And a year ago, or last year, the end of the year last year, we were at 1.51% in the 10-year Treasury, and a year ago, the same day, 1.29%. So you see, we've had a more than doubling over that past year. So I hope that all makes sense for you. Now we're going to talk about our financial planning topic. So I'm going to share my screen with you here. All right, I thought it was important to talk about financial planning, and you'll see here. But today we're going to talk about financial planning, the financial planning process and tools, because this is a difficult time and people have a lot of questions. We're not getting any clear guidance one way or the other on how we should be reacting, investing. Should we be, the large companies say we're not investing in stocks. Well, we're investing in stocks. We're not investing in bonds. We're investing in bonds. So who do you follow? There was who I missed? There was Riverfront as far as the analyst report, but they have now turned a more pessimistic approach. But so the question is really, who do you believe? How do you handle it? And I talked about asset allocation, account segmentation, principal protection. So in my opinion, they're really the foundation. You build, you use other tools around it, but they're the foundation that you need. But it's all based on the planning. One of the things that sometimes can be challenging for us and for clients of ours is that we take time in our process. So we have this 8-week process you can see here that we've developed over the years, and that's ideal. Sometimes at 8 weeks draws out a bit because we're waiting for information or waiting, particularly if life insurance is part of the plan. Sometimes that gets delayed because it's nearly impossible, in my opinion, to make sound investment decisions. And I would say impossible without having your plan in place. And the reason you want your plan in place is for times like this, because, just as a reminder, I did, 4 years in the Air Force, military police, 21 years altogether in law enforcement. We were always taught that when the stuff hits the fan and and it could be life or death, obviously in the military and law enforcement, but you rely on your training and experience. So there's all kinds of examples about that. And that's why if I go to the shooting range, I still do exactly what I did all those years. It's that muscle memory. You want that same kind of approach. You want that training, that annual financial planning process is your training. And then as the years go by, that's your experience, is that when you can say, okay, I get this. I don't have to panic. I can be concerned, but hopefully I'm not panicking. You want to make sure that things are getting taken care of for you and that you're on track. That makes sense. You don't have to wait for your year, of course, for most people to go through this financial planning process. If you want to review, an update intra-year, this might be a reasonable time for that. So, but you should, of course, go through this process every single year. So let's talk. So that lays your foundation, your planning foundation. You have your investment foundation, and then you can, derive some comfort from that. Our phones aren't blowing up, and they haven't been all year because, again, we're holding a lot of cash. That's helpful to people, that no one's had to sell positions that I can think of at any losses to fund their needs. So that's all positive, of course. So let's talk about the 8-week process. So you can find that on our website at any time, but I'm going to go through it with you. So let me tell you how I got here. So if you log on to attleborowealth.com and you go to services, you'll see financial planning here, and you'd click into there. And this is my quote: planning should be the primary driver for lifetime success. Otherwise, it's just luck. So the website developer, we were talking and they like that, so they put that in there. But I list here, the code of ethics as a certified financial planner. I, of course, think it's important. When you go talking about your team, I talked about the CPA before and how that CPA can save you time, frustration, and money. I believe that your financial advisor should be a certified financial planner. There's a lot of good reasons for that. You can actually click through to this piece, why you should choose a certified financial planner practitioner. This is the most difficult designation to get in our industry when it comes to financial planning. You've got to attend a bunch of classes, pass many tests just to be able to sit for the comprehensive exam, and only about 50% of the people at any given time pass that comprehensive exam, because it shows that you have proficiency in what you've studied. There are other programs out there that have different initials after their names that may sound like CFP or have another initial rather than a CFP, but what they're all missing is either the immense volume of the material, or the testing to show that you understand that material and you can apply it. The CFP requires that comprehensive exam for proficiency, and now that you present a financial plan. So, and of course, the code of ethics is very, very important. So we hear a lot about fiduciary, acting as a fiduciary, and they put it right in here: act in the client's best interest. No messing around with that. And I think that's very, very important. I once sat down with a prospective client, and she told me she had her financial advisor who worked at, one of the big firms. And she said, she asked the person if he was a fiduciary, and the person's response was, well, and gave her a long answer. And she said, I'm still not sure. And I said, well, that just means no. If you can't just say yes, then the answer is no. So I put in here a pretty good description, I think, of what to expect, and the items that addressed during that 8-week process: of course, goals and objectives, investments, tax, of course, insurance, not just life insurance and long-term care, but we look at disability insurance, your property and casualty insurance, your liability insurance, and then wills and estates. help you review your wills and see if they need to be updated. That other part of that team should be a, highly skilled, I believe, very competent attorney. Probably for most people, that should be someone who focuses on elder law as well, because most of the folks we work with are, above 60. And at some point, if you're not elderly now, you either have parents who are, or you're going to be at some point, and you want to develop that relationship. So we'll review wills, powers of attorney, healthcare directives, trusts. Had a phone call with a client's attorney yesterday discussing, very complex trust strategies. And we kind of went in a different direction after that. So these conversations and this team approach really helps, because you want everybody working in the direction for you. And then I laid out a typical 8-week process. So these are typically 1 to 2 hour meetings. And this first meeting, so we have the general consensus meeting, right? Identify the needs and goals, and this is how we're going to go through the process, and that we're going to, we do the engagement form so everybody understands what their responsibilities are and what they're doing. Client receives a lot of documents to complete, including a expense spreadsheet that we've developed over the years that you can still access on this website for the period of time, for probably for the next few months anyway. A financial planning questionnaire, also you can access that here. But there's a lot of information that we need from the clients, and then we gather that information during this break week, right? So you've got meeting 1, week 1, week 2 is when we're all doing our homework. Clients getting us information, we're going through that information, and then the third week, typically the meeting 2 happens. This is where we come to you and say, okay, this is what we've received. Let's make sure that we understand it correctly, and we're all on the same page. And this is often, well, you said that you spend $10,000 a month. We're seeing here it's $12,000 a month. Or is that difference correct? Or do we need to make adjustments? Or, so there's often things like that. Or, if there's real estate properties, cars, it can just be so many things. Major expenditures, we want to understand those. Many people are, taking care of their home improvements or getting their houses ready for sale, whatever it might be in that time going towards retirement or during retirement. And we want to understand those major things, weddings, celebrations, and all that fun stuff. In week number 4, we identify potential issues, risk, and develop solutions. And we go through that. Now we understand everything together, and then we're preparing for our solutions meeting. So week 5, meeting 3 is what we call our solutions meeting. And in that meeting, this is where we typically come and say, okay, this is how we think things should be done. This is what your investment should look like. This is what your Roth conversion should look like. This is how life insurance should be laid out for you, if that's what makes sense. And we get to that next step. And then we either, then from there, it's either go, no go, we make adjustments, whatever we need to do. After that, we typically present the findings for the client's secondary focus. Often that is the estate planning, but that could move up to the front. Some people come to us and say, first things first, I need to get my wills and estates in order. And we focus on that first. So there's a primary concern for most retirees. It's, do I have enough to live off of? How best to fund my accounts? How best to withdraw my accounts? And can I be tax efficient? So that's the primary focus for most people. Secondary, we go through the estate planning process or any other focus that they have. So, and then from there, of course, so we wrap that up. And then from there, it's implementation of everything and monitoring. Monitor it throughout the year. And then we do it all over again a year later. So it doesn't have to take 8 weeks in that second year. Sometimes we get it done in a month or just 2 meetings. Oftentimes we do, because we already have the information and we're just checking in at that point. But it doesn't mean that it's any less important, because there are often major changes between 2021 and 2022 and 2023 and, on down the road. So it's really, really important. And there are some files that you can grab off of the website here. If you want to look at our expense spreadsheet, confidential financial planning questionnaire, or this information from the CFP board. Now, part of that is also we set up your online access. And I have here Clients will know what this is, but this is Frank and Joanna Miller. This is a sample client. I'm not going to share anybody's client, but this is your e-money client access. So what most people like about this, and this is our financial planning portal that is available for everybody, and this is the client view. There are many things here that you'll see. There's some goals listed here. You'll see, of course, there's accounts listed here. I like to look at the investments up here in the financial or the e-money portal. And you can just see, you can just see what's going on, how things have grown or not. You can go into any investments and see what the holdings are. If you want to look at allocations, you can do that to see how you're allocated. If you want to do some analysis, you can, to see how the accounts have performed. You can look at transactions. This would have to be pulled in from the custodian. So all that is important. This vault is very helpful for all of us. I hope I'm sharing. I see a question. Doug, I'll come back to that, Doug. Doug's got a question about what the cost of the process is. Good question. So then this vault this only shows one because this is a sample client, but really what you typically see is many files in there. So the vault is someplace where you can upload documents and have access for you and for us. So anything you want to share with us, you put in here. So that's obviously secure because we all log in to get there. But we also will set up a folder for your taxes, your tax forms, your wills and trusts, any other thing you'd want in there, and any other thing that applies. People like this because of, with most couples, there's one person who kind of drives the bus. You might both be involved. Some people are just completely separated from it, but there's usually one person who guides things. And what people like about this kind of online access is that you've got one place to go for everything. And folks like that. So the report section is also great because this is where you can just see how everything is. Now, it opens up with your balance sheet, but that's a good place to start too. Frank and Joanna here, they have $3.3 million in assets, but after their liabilities are $2.8 million. So that's helpful. Some banks ask for that. It's nice to have that. Cash flow is another area where we spend a lot of time, and this shows the income that's coming in, any plan distribution. So that's what we're telling the plan to push out total expenses, plan savings, whether you have a positive cash flow over here or a negative cash flow. You're often negative cash flow in retirement, and that's okay because this is what you've saved your money for. Our goal, of course, is zero, right? But we don't want to push out more money than we need, for sure. So there's a lot you could spend just days in this report section to see what makes, what's best for you. And most clients tag a few reports that they reference all the time. Income tax is an important one. So this is, in this example here, we start with a tax inefficient portfolio and make it a tax efficient portfolio. And you really just flip this around. Because here you got this mountain chart where Frank and Joanna are, and we just want to flip that around, fill this up, and then have them at very low or no taxes in the future. So it's 10:44. I hope that information was helpful. The financial planning process, again, gives you that foundation so that you can look at these things, go through it with your advisor, your planner, and make sure that you're on track, even given what's going on. I will honestly tell you that increasing interest or inflation rates, as we did in our financial plans, to 3.5% on average, and decreasing the assumptions for investments over the next several years, has caused some plans to have problems, and we have to address those problems. And that's important. It's just as important to know what potential issues are as it is to know that everything's okay. So that plan gives you that foundation and that guiding, kind of that light to follow. Of course, the investment foundation is just as important. Asset allocation, principal protection, and account segmentation. I've talked about that a lot. Doug, to answer your question, so it depends. Most clients, we typically don't work with clients under $1 million, as you probably know. For those clients, the financial planning process is included with everything. So that's a comprehensive agreement that we have, and we include financial planning, the 8-week process, tax efficient planning with all that. If you have less than $1 million, or you just want us to do planning, the planning fee starts at $5,000 and it goes up from there. So probably the most expensive plan I've ever done is $25,000. A good average is probably $7,500, but it just all depends on the complex nature of the plan. But good question. Thank you. What we strive for, and what really we require is it has to be fair. The plan, that's where all the work is. That's all the time. I once presented to a few hundred financial planners in, I think it was Dallas, Texas, and there was an investment firm called SEI who was on stage before me, and SEI had talked about some studies that had been done that put the value of investment management for clients at 0.25%. Now we know that the industry charges 1% or more. So what this investment manager just told the entire room was that most of you are overcharging. So that was a really good segue for me, because I came up after and I referenced that, and there were a lot of grumbling in the audience. And I said, so where the value is and what we do is, from a fee point of view, a small amount in the investments are just as important to the success of the plan. But from a fee point of view, it's relatively small, 0.25% out of 1%. But the remainder of that fee goes toward, having a solid plan, having an executable plan, monitoring that plan. Your tax efficient strategy, often we save people millions of dollars over their lifetime by being tax efficient in their strategies. And there's no fee in the world that could make that up, right? So there's just tremendous value in this work. So I hope that makes sense. All right, folks, it's 10:48. I hope you have a great week. We'll see you next week. And if you need to contact me in the meantime, you have my email address. I look forward to seeing you all soon. Take care.